All right, we've got noon on the clock. Actually, just turned 12:01 for me. Should we get started?
Yeah, let's do it. We have a record number of attendees and registrants, so hopefully that keeps building up. But hello, everyone, again. Welcome back. I'm here with my colleague, Adam Armstrong. He holds the CFP accreditation and is an advisor at the firm. I am Austin Hageman. I am also an advisor at the firm, and I hold the CFA, CFP, and AWMA designations. Today, we'll walk through some of the slides in our quarterly market update deck. The charts will highlight key data points that our investment committees consider when making decisions. As always, feel free to submit questions in the Q&A box as we keep moving forward. We'll address them throughout, and if we don't happen to get to yours, we'll make sure someone follows up with you after. So we do have viewers who are not clients. So here is a quick 30-second background on the firm. We are what's called a true fiduciary, meaning we do not sell products or get paid to push specific investments or any type of personal finance solution for that matter. Plain and simple. Our clients pay us for quality wealth management advice, and that's the only compensation we receive. No commissions, no kickbacks, no hidden agendas. So our investment teams have institutional investment access, giving clients a broad and unconflicted investment universe. And then our independence also shines in different ways as well, including the fact that we have access to multiple private banks should a client need one. Adam, how did I do there? Anything you want to add before we jump in?
You did great. The only thing I would add is I am not being held captive here in this auxiliary office that I'm using today,
Yes.
but hopefully everything works out smoothly.
All right, let me flip here to. All right, so let's jump into the markets, starting with this slide that highlights an interesting trend when a Republican is elected into office. Adam, can you describe what we're looking at here?
Yeah, so in the fourth quarter, as many of our followers and investors know, and our clients know, returns were great post-election. So what this really looks at is returns for the S&P 500 broken out by the election year. So that would have been 2024. And then the inaugural year when the president actually takes office, which would be 2025 or 2021 to 2020, et cetera, those timeframes. The big thing here that we wanted to look at was twofold. First, the election is behind us, so we have certainty, quote unquote, of what is ahead. We know that the Republican Party won a majority across Congress in the House and the Senate. So that is, I would say, presenting a little bit of uncertainty in that there could be added legislation and therefore unintended consequences that come down the pipe because of that. That being said, when we look at Republicans versus Democrats winning and when they actually take office, there's some notable trends here. The first being that in the actual election year, you see a lot of back-end loaded returns, right? So Republicans, when they get elected, we tend to see a better election year market when all is said and done than when Democrats actually get elected. Okay, so nearly 2x the performance there. Why is that? We could speculate on a number of reasons, but my guess is that Republicans are seen as more business friendly, and therefore there's a lot more optimism that gets built up and priced into markets when the Republican wins. And we saw that this year as well. After Trump won, we had a very good return, therefore, through November and December as well. Now, the flip side is the case in the inaugural year. So what you see is that once they actually take office, any president who's been talking to their base largely through the election cycle, they have to govern the whole country. They have to move towards the middle, and that's what we tend to see take place. We also understand that legislation, while often promised, takes a lot longer to follow through and get enacted on. So what you tend to see is that Republicans, when they win, the expectations are very high, and it's a lot easier to come in below those expectations. So we see more muted returns in Republicans' first year in office compared to Democrats. which for the flip side, again, Democrats are seen as less business friendly. So maybe the bar is set lower and they actually end up having more upside surprise there, which leads to better market returns in the inaugural year. So this is not meant to be used as a forecasting tool, more to manage expectations, I would say. And then caveat all of this that we just talked about, still relatively low sample sizes when you think about how, really how few presidents there have been since the 20s when this data was taken.
Right. I think one of the important things here is this helps in the realization that of a key point that the market is constantly setting a hurdle rate. Investors are constantly setting a hurdle rate based on their expectations. So current prices today represent current investor expectations. So when a Republican is elected to office, the expectations are high. The market tends to do very well as they price in these new expectations. And then that bar tends to get set a little bit too high, which makes it harder to meet. And when whether it's earnings or whether it's inflation or any type of expectation can't reach that high bar, investors pull back, right, and reprice based on the new expectations, which could be part of what we're seeing here. The same effect is, I'm sure as investors, you're thinking under a Trump presidency, what is the best investment for me, right? What can I be investing in right now that is going to reap the best results over Trump's term? Well, I hate to be the bearer of bad news, but what you find is that the investments that typically do the best right after the election tend to be flat or perform negative over the entire term. And that is, again, in part due to that high investor expectation and then the failure to be able to meet those expectations. There is a part there that also is due to the fact that our political system is more complex than we give it credit for. So just because a president says he's going to do something, he or she is going to do something, doesn't mean it's going to happen, or it doesn't mean it's going to happen within the time frame that us as investors are expecting, or to the extent that we want. So it's really hard to make investment calls based on who's in office, if you put these together.
I would just say, too, any great president can maybe get 2-3 major pieces of legislation done during a term. And so, you can count on a couple hands the number of things that the Trump agenda has been looking to get done, whether it's, tariffs, tax reform, border security, whatever it might be, pick 2, maybe 3 of those if we're really expecting a fantastic term. So to be determined, but
Now,
we could see some volatility this year.
Sure. You mentioned tariffs, and I'm sure our listeners' ears perked up a bit. You can't turn on the news right now without hearing about Trump's latest tariff threats against Canada, Mexico, and China. In fact, the market is currently down today, or at least last I checked. And, what's being blamed is the tariff conversation, with the Dow being down. Last I looked was around like 60, I almost said 60 basis points. I hate when people say that. 0.60%, 0.60%, which translates to roughly being down 200 to 300 points. So on February 1st, if you've been watching the news, the administration officially announced new tariffs on these 3 countries, citing concerns over illegal immigration and efforts to curb the flow of fentanyl and other dangerous drugs into the United States. Since that point, both Mexico and Canada have come to the table with promises that have resulted in a 30-day tariff delay. And China has come and hit back with some repercussions of their own, most of which are lesser than was either expected or are considered, a slap on the wrist in the grand scheme of things. So, Adam, as an investor, how should we be thinking about these tariffs?
2 things of note. Markets are supposed to be efficient, which means they process all known information, just like we're trying to do here today. And the fact that markets are still pretty much above all-time highs, unless the market's sold off dramatically in the last 20 minutes we've been on this call, that tells me something, that people are maybe overreacting to from an emotional standpoint of what tariffs would actually mean. The University of Michigan Consumer Sentiment Survey just came out this morning, and 1 year ahead inflation expectations were 4.3% versus expectations for 3.3%. So that's consumer sentiment driven surveys, right? We could argue all day about who the people are that actually pick up those phone calls and answer the surveys. But the point being that people expect higher inflation, but that might not actually be the case. And I think if it were actually the case, the market would be telling us that, right? The second aspect of this is I think this is going to hurt Canada and Mexico a lot more than it's going to hurt us. About 80% of their exports respectively go to the US directly, right? So that's a big chunk of their exports being taxed at a higher rate. Whereas both of their imports combined for us are, I think, under 15% each, right, from each country as a part of our imports. So it shouldn't impact our day-to-day lives nearly as much as it will impact theirs. That's not saying that's a good thing, but if at the end of the day we can arrive at some sort of trade deal that's beneficial for both countries, or I should say all three countries, I think that's the end goal here.
Right. Part of me wonders, and this is all, personal thought here, but part of me wonders how much political posturing, the move was to include Canada and Mexico. They came to the table pretty quickly. And part of me wonders if Trump was looking for some sort of quick tariff win. Trump essentially gave them a layup. He knows Canada and Mexico don't want drugs flowing through their land, right? So sure, the push certainly helps, but it also feels like a calculated move in that, maybe Trump wanted to claim an early victory and paint the tariff strategy in a good light by, attacking, Canada and Mexico first with this strategy where he knew, we had a stronger arm, so to speak. And, the issue he was putting on the table was something that, he felt that they could relate to as well.
Yeah. I mean, it's possible. I don't know. I try not to blend politics too much with, with markets. It's really, we should be thinking about this in terms of what are the expectations. If the expectations are that it's really going to kickstart inflation again, and we don't see that, then that's a huge win for the economy and probably the markets as well.
Right. And I think the news tends to point a lot to Economics 101. It's very much shoot from the hip. Economics 101 says tariffs cause inflation, right? But what you find as an investor, if you really go back and you roll up your sleeves and you dig through the history, is Economics 101 does point in a general direction, but there are also so many competing forces that Economics 101 is rarely ever clairvoyant. What
if tariffs increased inflation by 0.5%? That's not good. What if AI use cases over the next 2 years decrease inflation by a full percentage point? Right? We can look at these things in a vacuum all day long. But, understanding what it actually means, to your point, it's sort of all theoretical and it's all, contextual textbook definitions of things. We need to see it play out.
Right. And even if you break down tariffs, right, as long as monetary policy does not become looser. So if it becomes looser, that's more money flooding into the economy. As long as it doesn't become looser, then there's only so much money to go around. So if consumers are spending more money on a tariffed product, that's being priced now at higher prices, they have less money to spend on other goods and services, putting an offsetting downward pressure on the price of these other goods, which goes into inflation and creates this netting effect that makes it so tariffs don't necessarily need to cause higher inflation, right? If your income's $20 a month and your spending's $20 a month, and your to spend on one specific good goes from $5 to $8, a $3 increase, that's $3 less I have to spend on something else. So there's trade-offs there, and that doesn't mean tariffs need to increase inflation. Now, I'll caveat that, just like I caveated, what the news people are pointing to with shooting from the hip. There are a lot of competing forces, so that's not the only equation we need to look at.
If only the news made things look nice and bright and rosy.
There you go.
Sarcasm.
Another thing we have going on right now is it's the season of market forecasts, right? I'm sure many listeners are either reading articles or watching the news where they're highlighting a specific firm, what they think about major investment catalysts for 2025, whether returns will be strong or weak. A lot of it is very interesting, entertaining commentary. A lot of it sounds very smart, and it is very smart and calculated. Adam, what are the firms telling us this year?
Well, as opposed to last year, people are universally more bullish, I would say, but there is a wider spread of how bullish, and there are still some bearish forecasters out there, which I think is noteworthy. Last year, we had a lot of flat to up a little, but like some pretty bearish people as well making their forecasts. And clearly now in hindsight, that looks like a terrible call because we had a great year in the market. Now, if you read into some of these forecasts, right, we put two quotes there on the side from Goldman Sachs and Deutsche Bank, a couple notable banks out there. They're highlighting in their words, right? Everyone puts a price target out there, and whether it's up 8% or 10% or 12% for an average market year, which is, you can see most of these fall sort of between that 6 to 12%, which is very average, I would say. Most of them are citing things like, valuations, earnings living up to valuations, despite being a bit pricey on the stock market. But then they cite risks too, right? Aggressive trade and immigration policies, potential for negative shocks or rising bond yields. So I think people are pretty much just hedging their bets, right? They don't want to stick their neck out and be wildly bullish, but they also don't want to be bearish at this point because, let's face it, we do have full employment in the economy. Wage growth is growing faster than inflation at the moment. That's a pretty good situation to be in as an economy. And I think we both agree with that, whatever it is that upsets this current economic expansion that we're in is probably going to be something that no one's talking about today.
Right. So how much weight should we be giving these forecasts?
That's a great question. Historically, not a lot. Right. Based on their historical forecasts and what we get in the market, we can look back and determine, should we even be paying attention to these forecasts, or is this just something that they're getting paid to do? Right. I said it before, but, you don't get the risk of being wrong when you stick your neck out on a forecast like this is a lot greater than the reward you might get if you're right. I will say that too. And we can look at last year, where we closed out the year around 4750, where we ended the year 1,000 points higher, up over 20% on the S&P 500. And you can see all these yellow lines across the screen here going horizontally. These were the levels of these forecasts from last year, right? So some bearish, some bullish, kind of centered around a 0% return year. That's not a very likely scenario if you look historically. In fact, most returns are either up a lot or they're negative because of some bad thing that threw the economy off of its course, some financial crisis, a bubble, whatever it might be, right? Outside of that, if you're in a bull market, it's more likely that you're going to have a 25% year like we had last year than a up 8% average year. We know that from studying the data as well. So I think the point here is we need to take all of these forecasts with a grain of salt. I think we can learn something from them. But if you look historically, sorry, it's like I haven't been moving around enough. The light dimmed in here. But if you look historically, where the market ends up being is more likely than not going to be outside even the highest and lowest range of these forecasts.
Right. And we show that here on this slide, where what we're looking at is, if we just focus on 2024 here, the bottom bar is the lowest forecast, the top bar is the highest forecast, and then we also show the median forecast here as this blue straight line, and then where the market actually ended up is this teal diamond.
So last year we had a number of people forecasting for bearish markets, down 5%, down 10%, down 15% was just about the worst forecast we had last year. And while there were some people calling for bullish markets, it wasn't overly bullish, 5 to 10%. And the median was right around that sort of zero band for a flat year. For most, the reason that most people were just calling for a recession last year outright, if you rewind back to the winter in 2024. And you can see here the market just completely overshot that because we never got that recession. And, the Fed started cutting rates, easing monetary policy. It was a pretty good situation. You could chalk some of that up to President Trump winning, right? And some optimism for the future with a Republican in office there. But 70% of these blue diamonds on the screen are outside even the highest and lowest forecast range. And I think what's worth noting is a couple things. When expectations are and forecasts are bearish, you tend to see some really good years. Now, when people are overly bullish and all expecting good years, you don't see bad years. You can still see good years, but it's oftentimes that they're even better than expectations, surprisingly, right? As individuals, we just have an inherent bias to be fearful of things that are already priced into the market and expected. And we assign higher probabilities to those bad things happening than the truth. I'd focus on, like, this year, there are some bearish forecasts, but the median is, higher than average, I would say, this year. When we plot this for next year, looking at this, you'll see that. But I equate this year to years like 2017, 2019, maybe 2021, where the forecasts are pretty unanimously bullish, except for a couple outliers, and returns exceed expectations so long as we don't have a recession.
Right. I just want to highlight what you said about 70% of these teal diamonds being outside of where the forecasts were. Just to point out that these companies are spending a lot of money, a lot of human capital, so a lot of people, a lot of people's time, a lot of technology, a lot of data points, right, in trying to figure out where the market's going to be, trying to make these investment calls, right, that are based on what are the catalysts out there, what are the pros, the cons, everything like that. And they still get it wrong 70% of the time. So it's not even 50% of the time, right? It's more than 50% of the time they get it wrong. So next time you're sitting there as an individual saying, you know what, I have the key to success. I know what's going to happen. I know this is a sure win, whether it's getting out of the market or getting into the market, right? I want you to take a second, take a deep breath, and think about all of the money and the human capital being spent on making these projections and the fact that they're wrong generally. I can't say all the time, but a good portion of the time.
Pretty solid majority of the time.
Pretty solid majority of the time. So we talked about expectations. Let's talk about actual fundamentals. Why don't you take some time to break this chart down?
Yeah, I'd say the most widely debated topic right now is just where we are from a valuation standpoint. We had a question come in prior just asking us to talk about general valuations across asset classes. We're going to stick to equities for now, but we'll reach out separately and make sure those questions and that conversation happens. The biggest thing right now is around the valuation concerns of these big tech companies, the concentration in the index, and what that might mean, and whether we should be selling equities, I guess. I mean, hopefully we never have to sell stocks if you're a long-term investor. But what this looks at, we're going to start with the chart on the left here. It's looking at the price to earnings ratio of the top 10 companies compared to the remaining stocks in the S&P 500. And then the green bar here is those top 10 companies. You can see there's a big spike up in around the dot-com bubble. Valuations got very stretched for the largest 10 companies in the market. In hindsight, we know that was a bubble based on not sound earnings, lots of inflated valuations, not following through and coming to fruition with actual profits and earnings of these companies. And we saw tech decline dramatically for years after that. Okay. And what you can see in 2020 and 2021, and even up more so today, is this increase in valuations of the top 10 companies. And people are worried again that, is this a dot-com bubble 2.0, where instead of the internet, we're talking about AI being a bubble, right? So what does it mean for numbers? The top 10 companies are currently trading at 30 times multiples, essentially. right? And the average, historically, the big companies do have a little bit of a premium because they're big for a reason, right? They have purchasing power, scales of efficiency, whatever it might be. The average is about 20 and a half times earnings. So we are overvalued by, 145% of historical averages. If you look at the remaining stocks, though, while prices are higher than average, sorry, not prices, but valuations, the multiple is higher than average. We're talking about 18.2 versus 15.7. That's only 115% of the historical averages, right? Being a couple of years into a bull market, that's not surprising to have valuations above historical averages, right? But again, if you look at the gray there, the overall index is not incredibly or wildly expensive, I would say. The next concerning thing here that we wanted to look at was just the concentration of these large names as it relates to the S&P 500 as a whole. And Austin, I know you'll talk about portfolio implications of this, but the top right chart here, the concentration of the top 10 names is incredible, right? It's nearly 40% as of the end of December in the top 10 names. By a market cap weighting represent the S&P 500. That's dwarfing the tech bubble in 2000, right, which only hit about 26, 27% at its peak concentration levels. So this is what a lot of people are drawing as a concern too, where, and we saw it back in a couple of weeks ago with the DeepSeek news, where NVIDIA sold off by 15%, and being at the time, it was one of the top largest companies, top three probably, with Microsoft and Apple, largest companies. When we lost billions and billions in market cap that day, and because Nvidia is 6-7% of the index, the whole index was down that day, almost 2%, when Nvidia was off 15%. The crazy part about that day was that 300 plus companies in the S&P 500 were positive that day. So the whole index was down 2%, but a majority of the companies did great. I think the Dow was almost positive, right? So you have these risks here in concentration, where if you're not looking under the hood and building a more diversified portfolio, you're leaving yourself open to some of these risks that are these companies don't exceed expectations, basically.
Right. If you look back, going back to 96, right, for a good part of the time, the top 10 was 20% or lower of the weight of the S&P 500. It did come up to around 25% here and there, but majority of the time it was 20% or lower. Now we're talking about double that. So the top 10 names represent double that amount. So what that means for investors is obviously that performance in the index is increasingly tied to the performance of just a small number of companies, right? Just like you said. So strong performance in these top 10 names can lift the index, but conversely, any significant downturn in these stocks could have a large impact on the index as a whole. And we do know that those who rise to the top of the kingdom, so to speak, will generally stay there for a bit, but they won't stay there forever. And we also know that the bigger they are, the harder they tend to fall. So we just need to keep that in mind from a diversification standpoint, from a risk management standpoint. Now, on the other side of the coin, when we look at valuations and we say, okay, the remaining stocks, the 490 stocks in the index are trading at an 18 multiple, while the top 10 stocks are trading at a 30 multiple. Why are the top 10 stocks more expensive? Why are investors willing to pay companies more to hold their stock than they are the rest of the market? So Adam, would you mind jumping in and talking a little bit about that?
Yeah, I mean, the real question is this just hype and AI news stories and nonsense, or is it something that can actually be backed by material earnings? And it looks like so far it's been the latter, right? That these companies are fetching a much higher multiple for their earnings because of two main factors, their earnings growth and their profit margins. So I'll just start on the right side of this chart at the top here. You can see the Magnificent Seven, just to look at that basket a little bit differently than the top 10. Yeah, they're growing their earnings at a double the clip of basically the rest of the companies in the index, right? So you kind of expect, you can see for 2024's earnings, the Mag 7 grew their earnings at 34% while the rest of the market grew it at just 3%. For 2025 forecasted earnings, that's supposed to even out a little bit. We'll see if that comes to fruition. So there's no doubt that these companies are spending boatloads of money, billions of dollars per year and per quarter on capital expenditures, right? Chips and AI related capital expenditures. I think we're going to need to start seeing some of this play out and lead to profits at the end of the day. But even so, we can look at the bottom chart down below on the right side. Their profit margins are much higher than the other companies in the index. Now, this is somewhat to be expected. Technology companies do naturally have higher profit margins than, say, a bank does, right? But let's think about this in much more simple terms and not stocks. Let's think about this as you're an individual and you're deciding whether to buy a business. I don't know, a laundromat. There's two for sale in your town. One of them has a history of being able to grow their customer base at twice the rate of the other laundromat. And they also have more efficient machines in the laundromat. So you get to take home more of the revenue that you generate, less of it's going to utility expenses, right? Are you going to be willing to pay more for that one that's growing faster and has a higher profit margin? Yes, of course. So I think that's what we've seen here. Now, bringing this all back to our prior conversations, a lot of this depends on future expectations and whether they remain and are still able to meet those lofty expectations that people are now assigning because of past performance.
Right. So a question we should be asking as investors is, are investors in aggregate being rational? And I think when you look at the numbers, is it rational to be willing to pay more for a company that has, earnings growth 2-3 times a multiple of the rest of the market? Or, is it rational to pay up for that? Is it rational to pay up for a company that has twice the profit margins as the rest of the index? I would say, yeah, that does seem rational. Of course, you would put more money in something that you think is going to earn you more money quicker, right? Or to a greater degree. So I think step one of the question, are investors being rational? I don't see how you can look at this and say that they're being incredibly unrational, right? So that's the takeaway here when we look at the data, underneath the hood, so to speak. So
yeah, I think some of this comes down to personal risk tolerance, time horizon for growth, things of that nature, because we know that in 2022, which was a poor year for these Magnificent Seven companies, if you look at the earnings per share growth, minus 14% for the Mag 7, the rest of the market did just fine, growing their earnings at 9% in 2022. The performance was dwarfed in that year as well. So that's the risk here. And depending on one's time horizon, one's tolerance for growth and tolerance for volatility, I think you need to look in the mirror and ask yourself, do you want 7% of your portfolio tied to NVIDIA when something like a DeepSeek could come about and, overnight, over the weekend, 15% of your position is wiped off the statement value there, right? So I think it's tangible earnings, but the stakes are getting higher as we go further into this realm.
Right. So, Austin just told me that investors are being rational and pricing these companies up. He also just told me that there's this concentration risk we should be careful of, right? Before I jump to the next slide, I just want to re-point out that the top 10 names in the index are trading at roughly a 30 multiple versus the remaining stocks is an 18 multiple, okay? So with that said, let's hop forward. Adam, I'm going to hand this over to you because I don't want to be responsible for explaining what's going on here. But I promise you, everyone, this is going to make sense in a second.
We've got a lot of dots. Okay, how was that for an explanation? No, I'm just kidding. what we started to hear with valuations rising towards the end of last year, we started to hear companies come out and lower their return expectations for the ensuing cycle, ensuing 10 years, whatever that might be, right? I think Goldman came out with their return projections for stocks to be about 3% annualized for the next 10 years. Very low, right? And they cited concerns over high valuations. And so we wanted to dig into the numbers a little bit more and say, is that really the case, historically speaking? So what we did is we plotted returns on the left side. So that's going up and down the y-axis here. We plotted total return of the S&P 500 on both a 1 year and 10-year basis. So the 1 year is the hollow dots, and the dark filled dots are the 10-year returns.
So each lighter dot represents a 1 year return, and each dark dot represents a 10-year return, right?
Yeah, we looked on these on a monthly rolling basis, 1 year returns and 10-year returns. Now, along the x-axis is the forward price to earnings ratio. So essentially how expensive or how cheap are stocks, and what does that mean for future 1 year returns and future 10-year returns? How did I do?
Perfect.
All right. So what you can see here is that on a 1 year basis, there's no real order to these dots.
So I'll just let me chime in, actually. So
yeah,
what we basically did was we said, all right, beginning of the year, the PE was here. Okay. And then what happened a year out? And then what happened 10 years out? So at the bottom here, this kind of led our information of at the beginning of the year, where was the PE? Then we placed the dot. And then we said over the next 1 year, where were returns? And then we placed the dot on this axis, and the returns were down below 40% for this year, right?
Yeah.
And same goes for this dot and this dot, so on and so forth. Those are all 1 years. And then the same concept for the darker dots, where we said, where was the PE beginning of the year? Where did it end up at the end? Where did it end up at the end of 10 years?
Yeah. So to me, and I hope all those viewing this slide right now agree, that it appears much less orderly with the 1 year return outlooks than it does for the 10-year outlook, right? And so what
I mean,
this means,
look at the 10-year here,
right?
Versus the 1 year here.
There's a much wider range of possibilities for a 1 year outlook if stocks are expensive or cheap than there is much more order and for 10-year forward-looking returns when stocks are cheap and expensive. So that can be measured by what's called the R squared, to get into econometrics or statistics. Briefly, to nerd out, this is just saying what percent of return can be derived from just looking at the forward price to earnings ratio of the index, right? So over the 1 year period, you can see it's barely anything. It's 0.02. So 2% of a return can be derived on a 1 year basis from whether stocks are expensive or cheap. Conversely, over a 10-year period, about 70% of forward returns can be explained by whether stocks were cheap or expensive at the start of that 10-year period, which is pretty significant in our eyes, and if you're a statistician. So what this is saying here is that, okay, stocks are expensive. If you look at the top 10, names in the index at, what did you say, 29 multiple, right? Stocks are expensive. So yeah, on a 10-year basis, maybe that gives us a decent idea that returns may not be that good. But in a 1 year return time frame, you can see stocks can be expensive and still give you very good returns over a 1 year period, right? Now, the cheap stocks over long-term returns over longer term 10-year periods tend to give you much better outlook for stocks, right? So this gives us both confidence and hesitancy at the same time when we look at the market, something like the market concentration, where yes, the market and the total stock market can do well. Maybe even the top 10 companies that are very expensive can still do well over the next year or so, right? But it gives us a little more pause when we look to, add to some of those names at this point. for their longer term outlook versus looking at the rest of the index, the other 490 some odd names, and saying those are pretty fairly priced at 18 times forward multiples, and maybe we've got better returns not just in a year but over the next 10 years if we look towards the rest of the market.
Right, right. And we even looked at this over 5-year intervals, and the R squared is 0.2. So 20% of the time, PEs were a good indication of where 5-year returns ended up. So, from 0 to 5 years, from 1 to 5 years, this is pretty meaningless to us. When you start going past 5 years, and not necessarily year 6, but past 5 years, that's when the data becomes more and more meaningful. So, we just said, or I just said, investors, could potentially be acting rational by pricing up the top 10 largest names because they're growing earnings quicker, they have better profit margins. Well, I'm also going to point out that if you look at where a PE of 30 is and where the dots are, in terms of returns going 10 years out, right? They are flat to negative. Okay. When you look at the rest of the market trading at an 18 multiple and you look at where the dots are, we're talking, 5% up, probably 5 to 15%. Now,
Those are annualized returns, right?
Annualized returns, right, right. And now this R squared, or this, think of it as an easy way to think of it as probability of being right, is 70%. 70% historically, 70% of the time historically, PEs have provided a good indication of where returns are going to be, annual returns are going to be. However, that still leaves 30% that they're wrong. So, there is also a margin of error here that we need to consider. So while, it makes sense why investors are willing to pay up for the top 10 names, we also need to keep the bigger, longer term picture into account. I would think of PEs as a hurdle rate. Okay. A PE is quite literally telling us that investors are willing to pay X amount for a specific amount of expected earnings. So as long as that company hits that expected earnings or exceeds that expected earnings, right, the stock should stay flat or continue to do well. As soon as the company cannot hit that expectation for earnings, okay, you tend to see the stock price drop. And the higher the PE, and based on a couple variables of where earnings actually meet versus expected, right, that price could come down pretty dramatically. So we need to take that into account. So as these top 10 companies keep having earnings that make investors increase their expectation for earnings, we should continue to see PEs or valuations for these companies get more and more and more and more expensive. And think of that as a hurdle that gets higher and higher and higher and higher. Okay. So as that hurdle gets higher, the risk of disappointment also grows. So as that risk of disappointment grows, eventually expectations tend to grow too high, making these stocks susceptible to those sharp downturns I was saying when news comes out that suggesting that the investors' expectations are at risk. Okay, so we need to take into account this tug of war here, where while we need to respect the growth potential of these names and their ability to drive returns, we also need to be mindful of the dynamics that come with concentration exposure, right, and high valuations. Yeah. From an investment perspective, it's important to ensure that we show some sort of balance here, right? And a lot of this is dependent, to your point, Adam, on investor profile, right? Is the client more considerate about high cash flows? Do they want more total return? Are they more conservative versus more aggressive, right? But for that traditional, rule of thumb investor, right, we need to be able to balance the high growth potential here, but then also the risks that we're seeing and show some level of balance, okay, where we're able to capture the upside from some of these high growth potential names, but we're also expanding our opportunity set, which should theoretically help us from both a risk perspective and a return perspective over longer periods of time.
Yep. Well said. All right. We nerded out a little bit. A lot of bit. What do we have next?
So the last slide I will bring up here, I think is important. Let me just get rid of this drawing here. I think is important because it's been a while since we've seen this play out over the course of a good year to this extent. Where is it? Here.
There we go.
So what we're looking at here is the gray bars are calendar year returns. Okay. How did the market perform over the year of 2024, 2023, et cetera? The red dots represent the intra-year decline. So from peak to trough, the intra-year decline. So if we look at 2024, the intra-year decline was 8%. I believe that happened in August, right? But when you look at the entire calendar year, the market was up 23%. Now, right, on average, the market will see an intra-year decline of about 14%, which we haven't seen in a while unless it was already a down year. We did see it very, quickly during COVID, right? But just to point out some years, right, during COVID, the market fell 34%, ended up, where is this, 16%? Right? Yeah, 16%. We have other years, right, where the market was down 14%, ended up 26%. Yeah. Or down 19%, ended up 27%. And I think what this points to is why we get rewarded for being stock investors. We get rewarded for being stock investors for assuming the short-term risks and the volatility, right? When the market is falling 10, 15, 20%, that should be expected as a stock investor, right? That expectation should be built in because that's why we're getting rewarded for the high returns. And these returns are not normal, right? If the market were to fall 15, 20% this year, that doesn't mean it's not a normal year because on average, and it's only the average, the market is down 14%. So averages are averages, right? That means it was down less than 14% some years, down more than 14 in some years.
Yeah, I think this points to the fact that we should expect volatility, but just because we may get and we'll probably get some level of volatility, let's call it a 10 to 15% correction, just because we get that type of volatility doesn't mean we pack it up, sell all of our stocks, volatility is coming. No, you can still have great years. When all is said and done, if you expand your time horizon a little bit, looking at the late 90s, we had a question asked, what time period historically is most similar to today? And there's honestly a couple that I could point to, but they're all sort of in the 90s because that was when the internet came about. And, are we in the infancy of the 90s when the internet was just being thought of as it relates to AI? Are we in the mid 90s when the Fed cut rates a couple times? We didn't enter a recession. And we saw a massive, we saw the internet play out with massively positive use cases for corporate personal lives, right? Maybe we're on the brink of some sort of AI breakthrough. A lot of people use ChatGPT today, but honestly, is it really improving our lives all that much? I don't know. Maybe that's agentic AI, right? Having an AI agent do things for you, like build a website or start a business or whatever it might be, right? So we could be like the mid 90s. Now we could also be like the late 90s, where if all of this capital expenditures turned out to be malinvestment and there's no real use cases that people can grasp onto and understand how it's benefiting their lives. Hopefully that's not the case, right? And I would say that's probably least likely at this point. I mean, Elon Musk and Tesla are building literal robots that are going to maybe be in our houses in the next 2 to 3 years, doing our laundry for us and cleaning our dishes for us. That would be pretty amazing.
Wild to think about. But it's also
it's crazy to think about that.
Yeah, 20 years though, it was also wild to think that you'd have a computer in your pocket, right?
Yes. I mean, rationally, the next thing I always think about is when is the chip going in my brain where I can just do all this stuff naturally.
Right.
But that's all this is to say, even in those late 90s years, there were great returns, which we know, and it ended up being somewhat of a bubble. There were huge corrections during those years as well. Right. And when all is said and done, we need to take the good with the bad if we want to get long-term average returns of, 8, 10, 12% on a total return basis out of the index as a whole.
Right. So we had a question come in about are you anticipating any new tax laws for 2025 and beyond? I would say since we are not accountants, we don't try to make too many predictions within the tax space. However, the thought process is with the Trump presidency, tax laws would be more likely to stay the same, maybe even look more attractive going forward as opposed to a lot worse, right? We're putting our money on the same, maybe better, more than of the a lot worse, button, so to speak. We also had a question.
Going back to,
Oh,
I just
go
say
for it.
on that point really quickly, going back to the tariff conversations, I think if it were more widely believed that the increased revenue from tariffs was going to be used to offset lower taxes, I don't know that the market would be reacting this way, right?
Right.
So that's something that's maybe underappreciated as it relates to tariffs and taxes.
Right. We had a question come in about predicting oil, gas, and energy sectors. I'm assuming, that's in terms of returns. You want to take a stab at that, Adam?
Yeah, I would just say, one of Trump's, premises that he ran on was drill, baby, drill, right? So when I hear that, I think that's good for drilling and, more production, and deregulation is a staple of typical Republican policy. Those are all good things for oil production, but it might not be good for the price of oil. Last I checked, oil companies probably want the price of oil to be high when they produce and sell it at the gas station and refine it. So that probably flows through to better earnings, better profit margins, et cetera. So I don't know that more drilling is going to ultimately help the performance of these energy stocks. I think energy's been one of the weaker performers here since the election as well. I might expect that to continue.
Right. Right. Again, lots of cross currents. You
What
look
was
at
that? Energy was one of the worst performing sectors during the entire first term of President Trump, right?
I was going to mention that, right? Everyone got excited about energy when he initially got elected, and then ended up being one of the worst performers. So you never quite know, what's going to
So
happen. That goes back
maybe
to what we said earlier.
maybe that means people are too pessimistic now, right? Should we start playing the reverse engineering game of like, should we be zigging when everyone else is zagging? Be the
Right.
contrarian there.
Right. Because there are a lot of cross currents, right? AI, driverless cars, they need infrastructure for energy, right? They need more energy. So there should be some companies you would think theoretically that could do good, as we keep increasing our use of AI and things like driverless cars and electric cars, things like that.
What I would say about the energy sector is it's about 3% of the entire S&P 500. So keep that in mind. And, if for our clients, we're conscious of that in allocating to various sectors of how does that relate to the overall market? And, do we want to be overweight, underweight, same weight as the index as a whole when we're constructing portfolios? But for those that are not clients on the line, if you want to have us review your portfolio, we're always happy to do that. But over concentration, if you're right, it can be a great thing. If you're wrong, that can be detrimental to your long-term success as an investor.
Right, right. There was a question that came in about chatter regarding FINRA acting in a similar manner as US aid and working against market transparency and efficiency. What potential shockwaves, impacts to the market would you see if FINRA is abolished and the SEC takes over all market regulation? So we're not lawyers, right? That's not our specialty. So we really can't talk from a place of experience. However, I would think that FINRA is not going anywhere. It does take resources to oversee the industry, right? However, if FINRA were to go away, or maybe FINRA gets thinned out a bit, you would think that the government would have a plan of taking care of what needs to get taken care of, which my mind immediately goes to protecting the end investor, whether it's investors who are working with an advisor or just investors in general.
Yeah, my only comment would be, I think during Trump's first term as president, he toyed with the idea of making basically enacting a fiduciary standard and law across, something that you talked to in the very beginning, right? We are fiduciaries. We're structured as a registered investment advisor, as opposed to brokers who are governed by FINRA. They have a suitability standard, right? As opposed to, a fiduciary duty that we have for our clients. And I think it was, like a majority of brokers came out and said if that was the case, they'd switch
Right.
careers.
There was a revolt.
Right.
I don't want to work in the
So
best interest of my clients. I'll just do something else.
I
That's what they were
from a
saying.
morality, yes, exactly. From a morality standpoint, I would love if the SEC had a fiduciary standard across all financial advisors, but that's just not the case today. That's one of the reasons I'm personally proud to work where I work and do what I do is I take that fiduciary duty to my clients with the utmost seriousness.
Right. And that may have been Obama, or was it both of them? The Obama and the Trump administration. I forget. It was a while ago. Either way,
one of the two.
Either way, I guess understand what you mean. So,
our we have one last question come in, and then we'll wrap it there. Are bonds an attractive investment at the moment? Austin, you want to take a stab at that?
Sure. So I would say that bonds are on a relative basis, are attractive at the moment relative to the past, right? Relative to cash returns, but not necessarily relative to stock returns. I think as rational investors, we need to, where it makes sense to have an expectation that in order to take on a stock risk, I'm going to get paid for that stock risk, or else returns will go down, and there won't be any point in taking that risk, right?
Yeah.
But as a bond investor, if I'm looking at bonds now relative to where they were in 2016, 2017, I'm having a day, right? If my investment policy is 100% bonds, I am making sure that I am moving out to the extent I can in terms of duration, right? Locking in rates right now where I can. That makes sense for my overall wealth plan, because rates are higher. The Fed has moved rates up, right? Purposefully, unorganically. They moved rates up, created this higher interest rate environment. Rates will eventually come down. Sure, could they come up more from here? I guess so. I wouldn't put a large bet on that, but they could. I think, or could they stay around the same? They could. But in the long run, we would expect rates to eventually come back down as the Fed starts to lower the Fed funds rate, which brings that market down. So as a bond investor, I'm loving this. But if my choice is, if I'm usually a 60% stock, 40% bond investor, am I going, 40% stocks right now and favoring bonds? No, I'm not. I'm still, looking at the investment universe as a rational investor saying, if I'm going to take on stock risk, it's because there's returns there. And I'm going to put my high returning money that I would want to see high returning in stocks, and then put my money for stability and diversification for expected cash flows in bonds.
That's right. Yep, I agree with that completely. It depends on everyone's individual preference for growth, time horizon towards achieving your goals, et cetera. Yeah.
Right. So great.
Awesome.
I really, really appreciate everyone's time today. Just a reminder, there will be a survey. Please fill it out. Let us know what you think. We do enjoy reading good comments, bad comments, everything in between. And then also, when you get our emails about the next quarterly webinar, please share it. Share it with anybody you think makes sense. This isn't exclusively to clients or people in our network, so feel free to share. We don't have any restrictions on the amount of people or anything like that.
Excellent. Thank you, everyone, for tuning in.
Thanks, everyone.